There's a piece of retirement advice so common it's almost background noise. Move to a state with no income tax, and you'll pay way less in retirement. Florida, Texas, Tennessee. No state income tax, so your pension, your 401k withdrawals, your Social Security, none of it gets taxed by the state. It sounds obvious, and for some retirees, it genuinely pays off. But here's the honest check, and it surprises almost everyone. A no-income tax state can cost you more than a state that does have an income tax. Not because of some trick, because a state doesn't need an income tax to take your money. It just takes it through a different door. There are 3 of those doors, and the headline only shows you one. So the real answer to what's the cheapest state to retire is not a state at all. It's a question about your own money. Let me show you the 3 doors, the people who get this wrong in 3 different directions, and the 2-minute way to compare any state honestly, before you sell a house chasing a slogan. I'm Jeffrey. On this channel, we take the retirement claim everyone's heard and check it against the actual rule. No fear, no hype, just what's written down and what it means for your money. Here's the deal for the next 20 minutes. First, the 3 taxes every retiree actually pays, and the one mental model that fixes this whole question. Then you'll meet Doug and Marlene, who did the smart thing and moved to a no-tax state and watch their tax bill go up. Then the real 2026 map, the states with no income tax, the shrinking list that still taxes Social Security, and the surprising states where your retirement income is completely tax-free. And 2 more people, one about to move for nothing, one panicking about a tax he doesn't even pay. By the end, you'll stop asking, does this state have an income tax, and start asking the question that actually decides your bill. Before we start, let me name why this one fools careful people. Because it's not carelessness, it's visibility. No income tax is a single, clean, sticky fact. It's printed on the state. It's in every headline. You can see it on a map. The other 2 taxes you'll pay, property tax and sales tax, are invisible until the bill actually lands in your mailbox or rings up at the register. So people optimize the tax they can see and quietly ignore the 2 they'll actually pay every year for the rest of their lives. That's the whole trap. Once you're looking at all 3 doors instead of one, the question, what's the best state to retire, completely changes shape. So let's put all 3 on the table. Here's the mental model that fixes this, and it's just 3 items. In retirement, a state can tax you 3 ways. Door 1, income tax, on your pension, your 401k, and IRA withdrawals, and sometimes your Social Security. Door 2, property tax, on your home, every single year, whether you have income or not. Door 3, sales tax, on almost everything you spend. The Move to Florida headline only touches Door 1. It says nothing about the other 2. And for a retiree, someone who owns a home and spends most of what they bring in, property and sales tax aren't small print. They're often the bigger number. So here's the one thing I want you to take from this whole video, and I'm going to repeat it until it sticks. Don't memorize the states. Memorize the 3 doors. Every surprise in this video, every single one, comes from a state winning on one door and quietly collecting through another. Let me show you what that looks like with a real decision. Meet Doug and Marlene. They're 68 and 66. They've had enough of northern winters, and they've decided to sell their paid-off house and move to Texas, specifically because Texas has no state income tax. Doug did the math on door 1. He figured they'd save a couple $1,000s a year in state income tax on their pension and withdrawals. And he's right about that piece. But here's what Doug didn't put in his spreadsheet, the other 2 doors. The house they're buying in Texas is worth about $500,000, and it comes with roughly $8,000 a year in property tax. Back home, their property tax was a fraction of that. So Doug saved $2,000 on income tax and took on something like $6,000 of new property tax. Net result, their total tax bill went up by several $1,000s a year in the state they moved to precisely to lower it. Now, I want to be fair to Doug and Marlene because moving to Texas might still be the right call, for the weather, to be near grandkids, for the cost of a house. Those are real reasons. But if the reason on the spreadsheet was, we'll pay less tax, the spreadsheet was wrong because it only had one of the 3 doors on it. Doug's not being foolish. He's doing exactly what the headline told him to do, optimizing the one tax he could see. And that's the trap in a sentence. He watched door 1 and walked straight through door 2. So before we name names and states, let's actually open all 3 doors. Because once you see how a state makes up for no income tax, Doug's surprise stops being a surprise. Start with what the headline gets right, because it is real as far as it goes. As of the 2026 tax year, 9 states have no broad income tax at all. In those 9, your wages, your pension, your 401k and IRA withdrawals, and your Social Security are all free from state income tax. New Hampshire just joined the fully income tax-free club. It repealed its old tax on interest and dividends at the start of 2025. If your retirement runs mostly on a big pension or heavy 401k withdrawals, that door 1 savings can be very real. So far, so good for the headline, but don't memorize this list. You can put it on the fridge later. Remember the doors, because door 1 is the only one this list closes. Watch what door 2 is where Doug got caught, and he's got a lot of company. 2 of the most popular no-income tax destinations, Texas and New Hampshire, have some of the highest property taxes in the entire country. In Texas, a $500,000 home runs you roughly $8,000 a year in property tax. Every year, on a house you already paid for. New Hampshire's effective property tax rate is around 1.5%, again, among the highest anywhere. So picture a retiree who moves from a modest income tax state to Texas to escape state taxes. They stop paying a couple $1,000s of income tax, and they pick up an $8,000 property tax bill they never had before. On paper, they move to a no-tax state. In reality, their total tax bill went up. That's not a rare edge case. That's the single most common way this headline burns people. Door 1 closed, door 2 swung wide open. And there's door 3, sales tax. A state with no income tax and modest property tax still has to fund itself somehow, and often the answer is a high sales tax. Tennessee is the classic example. No income tax, but its combined state and local sales tax is among the highest in the country. For a retiree, that matters more than it looks, because in retirement, you're spending a large share of your income. Groceries, a new roof, the car, everyday life. A high sales tax is a quiet percentage skimmed off almost everything you buy for the rest of your life. It never arrives as a tax bill, so nobody counts it. But add it to the property tax, and you can see how a no-income tax state ends up collecting plenty, just not through the door you were watching. Let me put all 3 doors into one number, because it's the number that actually matters. Researchers who add up income, property, and sales tax as a share of what a typical resident earns get what's called the total tax burden. Rank states that way, and the picture stops matching the headline. Plenty of states with an income tax land right alongside the no-income tax states once you count all 3 doors instead of 1. And here's the cleanest proof that the label lies. Washington State has no income tax at all, but it has one of the steepest estate taxes in the country, charged on what you leave behind. No income tax, real tax. That's the whole lesson in one state. A label on a map tells you almost nothing about your actual bill. So say it with me. Don't memorize the states. Memorize the 3 doors. Now let's put Doug and Marlene's whole comparison on one page, because seeing all 3 doors at once is the thing that changes minds. Back home, in their old income tax state, say they paid about $2,000 a year in state income tax, plus about $3,000 in property tax, plus sales tax on what they spend. Call the total something like $6,000 a year. Now Texas. Income tax. 0. A real $2,000 savings. But property tax on the new $500,000 home, about $8,000, plus Texas sales tax. So their new total isn't $6,000 minus 2, it's 0 plus $8,000 plus sales, call it $9,000 or $10,000 all in. They chased a $2,000 savings and walked into a bill $3,000 or $4,000 higher. Same family, same income, moved to a no-tax state, and their tax bill went up by more than the thing that sold them on it. 2 of the 3 doors were. Let's pause for 30 seconds, because if you just joined, here's the whole thing so far in 3 lines. 1. The claim is real. Some states truly have no income tax, and for some retirees that saves real money. 2. The headline is incomplete. Income tax is one of 3 doors, and a no-tax state can collect more through property and sales tax than an income tax state ever would. 3. Your answer depends on your situation. Your income, your home, how you spend. That's it. Don't memorize the states. Memorize the 3 doors and run your own numbers through all 3. Now, with that in hand, let me introduce the 2 people who make the opposite mistakes, because they're even more common than Doug. The first is about to move for nothing. Meet Ellen. She's 70, widowed, and she lives in Pennsylvania. Ellen has been reading those best states to retire for taxes lists, and every one of them dings Pennsylvania for having a state income tax. So Ellen has started seriously thinking about uprooting her whole life, her doctors, her church, her friends, to move somewhere tax-free. Here's what nobody told Ellen. Pennsylvania has a flat income tax of 3.07%, but it does not tax retirement income. Not her pension, not her 401k and IRA withdrawals at her age, and not her Social Security. Ellen, sitting in an income tax state, is already paying 0 state tax on her retirement income. She's in one of the friendliest states in the country for a retiree, and she's thinking about leaving it because a listicle put the words income tax next to her state's name. She's memorizing the label instead of the doors. And Ellen is not a special case. She's an entire category people miss. There are income tax states that are among the best places to retire, precisely because they carve retirement income out of door 1. Pennsylvania, like I said, flat 307%, retirement income exempt. Illinois, a flat 4.95% on wages, but it exempts your pension, your 401k, your IRA, and your Social Security completely. Mississippi exempts Social Security, pensions, and retirement account withdrawals too. In all 3, a retiree living on Social Security, plus a pension plus normal withdrawals, can pay essentially 0 state. Let me put Ellen's move on the same 1-page test we gave Doug, because the math is almost funny. Right now, in Pennsylvania, Ellen's state tax on her retirement income, her pension, her withdrawals, her Social Security, is 0. Not low, 0. She has already captured the entire no income tax on retirement benefit that the listicles are telling her to move for. So what does moving actually get her? She'd be leaving a state where door 1 is already closed to go to a no income tax state where door 1 is also closed, the same 0. Except now she's buying a new house, in a new market, with a new property tax bill she doesn't have today. She'd pay thousands to relocate, plus whatever door 2 costs in the new state, to purchase a savings she already owns for free. For Ellen, moving for the taxes isn't a small win or a wash. It's spending real money to end up in the same place, or worse. The label said, income tax state. The doors said, you're already home. Here's a wrinkle that changes the answer for some of you, whether you own or rent. Everything I said about property tax being the door that sinks the no income tax move, that assumes you're buying a home. If you're going to rent in retirement, you don't pay the property tax bill directly. You still pay it indirectly, baked into your rent, but you're not writing an $8,000 check to the county every year, and you're not exposed to it spiking. So for a renter, a no-income tax state with high property taxes looks a lot better than it does for an owner. Flip it around. If you're going to own an expensive home, property tax should weigh more heavily than income tax because it's the bill that scales with your house and never stops. Same 3 doors, but which one matters most depends on how you're going to live. Own a pricey home, watch door 2. Rent, watch doors 1 and 3. The second person is panicking about the wrong number entirely. Meet Gary. He's 67, single, and he lives in Colorado, one of the states that still taxes Social Security. Gary saw a headline that said, "These states tax your Social Security," found his state on the list, and now he's convinced he's getting robbed and needs to move. Here's Gary's actual situation. Yes, Colorado is one of only 8 states that still tax Social Security benefits in 2026, but almost all of those 8 apply income limits. Below a certain income, your Social Security is fully exempt even in a state that taxes it. And here's Gary's specific rule, because it's worth seeing. Colorado lets anyone 65 or older subtract their full Social Security benefit from their state taxable income. Gary is 67, so by Colorado's own rule, his state tax on Social Security is 0, not reduced, 0. He is ready to sell his house over a bill that, for him, does not exist. He's fleeing a tax that was never addressed to him. And Gary should know one more thing that takes the fear down further. This list is shrinking fast. Back in 2020, 13 states taxed Social Security. In 2026, it's down to 8. and most of them exempt lower and middle-income retirees. States keep dropping off. West Virginia finished phasing out its Social Security tax on January 1, 2026. Nebraska dropped its tax in 2025. Missouri ended its recently. The trend is clearly toward exemption, not more tax. So if you're a middle-income retiree worried your state is quietly taxing your Social Security, first, check whether it's even one of the 8, and second, check the income limit because you're very likely already exempt. That is a very different situation from, I have to move. So here's the one list worth writing down. And then the thing to actually remember. There are 13 states where your retirement income faces no state tax at all, not your Social Security, not your pension, not your 401k or IRA withdrawals. 9 are the no income tax states. 4 are income tax states that exempt retirement income anyway: Illinois, Iowa, Mississippi, and Pennsylvania. And Michigan is on its way in, phasing out its retirement income tax by the 2026 tax year. Put that list on the fridge. But here's the part to keep in your head, because it's the whole video. Even on this list, that's door 1 only. A Texas retiree pays 0 income tax and a big property tax bill. A Pennsylvania retiree pays 0 on retirement income and a moderate property tax. The list tells you which states close door 1. You still have to check doors 2 and 3 for your own situation. Don't memorize the states. Memorize the doors. And because this gets oversimplified into bad decisions, let me flag the fine print the listicles skip. First, in Mississippi and Pennsylvania, a withdrawal you take before age 59.5 may not count as retirement income, which means it can be taxed even in those friendly states. So an early retiree tapping a 401k at 57 can't just assume it's exempt. Second, Iowa's retirement income exemption kicks in at age 55. It's not universal, so a younger early retiree there is still taxed. Third, and I'll keep saying it, none of these exemptions touch property or sales tax. My state doesn't tax my pension, and my state is cheap to retire in are 2 different sentences. The first is about 1 door. The second is about all 3. And one more trap for the movers. If you relocate but keep a foot in the old state, a house you didn't sell half the year up north, the old state can still consider you a resident and tax you. States are aggressive about this because I moved to Florida on paper and I actually changed my domicile are not the same thing. If you move cleanly and keep the records to prove it. So here's the honest way to compare any 2 states, and it takes about 10 minutes at the kitchen table. Step 1. Write down your retirement income mix. How much Social Security, how much pension, how much you'll pull from 401k and IRA accounts. Step 2. For each state, answer 3 questions, 1 per door. Does it tax Social Security? And if so, are you under the income limit? Does it exempt your pension and your withdrawals? And what's the property tax rate on a home your price, plus the sales tax? Step 3. Add up all 3 doors in each state against your mix and compare the totals. That's it. Not, does it have an income tax? The total of all 3 doors, run against your actual money. 9 times out of 10, when people do this honestly, the obvious tax-saving move gets a lot less obvious. And sometimes the state they were about to leave turns out to be the cheaper one. So let's answer the question in the title honestly. Is a no income tax state really cheaper to retire in? Verdict: it depends. And it depends on you, not on the map. If your income runs heavily through a pension and big withdrawals, and you can land somewhere without a giant property tax bill, the headline can absolutely pay off. But if you own a nice home in a high property tax state like Texas, or you're already sitting in a retiree-friendly income tax state like Pennsylvania or Illinois, chasing the no income tax label can cost you money and uproot your life for nothing. A state doesn't need an income tax to take your money. It just takes it through another door. Add up all 3 doors, run them against your own income, and the real answer appears. It's frequently the opposite of the slogan. So here's your short list for this week, and it's genuinely short. 1. Write down your actual retirement income mix. Social Security, pension, the withdrawals you'll take. You can't compare states without it. 2. If you're in one of the 8 states that taxes Social Security, look up your state's income limit before you worry. You're probably already exempt. 3. For any state you're dreaming about, look up 3 numbers, 1 per door. Does it tax retirement income? What's the property tax on a home your size, and what's the sales tax? And add them up, not just the first one. And 4. The one that saves people from a very expensive mistake. Do not sell a house and relocate for taxes until you've run all 3 doors in both states. Those 4 take an afternoon, and for a lot of you, one of them will stop a move in the wrong direction. If this took a piece of advice you've heard 100 times and turned it into 3 doors you can actually check, that's exactly what this channel is for. 1 loud retirement claim a week, checked against the real rule, calmly. Send this one to somebody who's talking about moving to Florida or Texas for the taxes. The one person you just thought of, because 10 minutes of honest math beats a moving truck pointed the wrong way. And subscribe, because next time we're doing one of the most powerful and most misunderstood moves in retirement tax planning, the Roth conversion window. There's a stretch of years, right after you retire and before big required withdrawals kick in, where converting money to a Roth can save you a fortune in lifetime taxes. Or, done wrong, spike your Medicare premiums and hand the IRS money for nothing. I'll show you exactly how the window works and how to know if it's open for you. I'm Jeffrey. And when the next best state to retire list scrolls by, remember what this whole video was really about. States don't tax labels, they tax people. So check your numbers, check the rule, not the slogan. One important note before you go. This is educational only, not personal financial advice, and not tax or legal advice either. State tax law changes every year, and the specifics, which states tax Social Security, the income limits, the pension and withdrawal exemptions, the property and sales rates, are the 2026 tax year as I recorded this, drawn from the sources in the description. Your own state, your income mix, and your home value decide your actual bill. Run your real numbers, or check with a tax professional who knows your state before you relocate or change your plan.